Hello, ladies and gentlemen. Today is August the 5th, and this is another episode of Two Grey Beards. Hi, Andy. Well, we had some excitement last week. What happened?
We sure did. So, as we had been expecting, the quarterly refunding announcement was released on first Monday, and then the composition of issuance was released on Wednesday. And both numbers were very high. We had very high expectations for these numbers. Um, but they were much higher than anyone, including us, expected. For instance, the government increased its borrowings in this quarter, Q3, to $1 trillion, up from 772 billion that had been forecast. And for next quarter, Q4, while most market participants expected 550 billion, they forecasted 852 billion. And those are just enormous numbers and came from falling tax receipts
And that's
and,
important.
yep, and rising expenditures, a lot of that expenditure being interest that the government is now paying, but also CPI linked mandatory expenditures. And so we're running a much bigger deficit and we're going to be issuing a lot. And so the important data came out on Wednesday morning. And in that data, we found that the government had shifted from, in Q3, almost all bills issuance to fund that $1 trillion number to Q4, where they're going to issue still a relatively low percentage, but a lot more bonds. A total of, I think the number was 338 billion of long-term, medium-term, and short-term treasury bonds instead of using bills. And that's what impacts assets. And so last week, that data came out, 30-year bond yields, TLT fell for the week, equities fell for the week. And that's consistent with our thesis that issuance by the government to pay back the Fed has is now going to be impactful.
Yeah. The bond market, as you said, had a very violent reaction, both in the curve and in the outrights. If you have a look, really, the 2 year actually on the week fell 11 basis points. And that is an indication of a steepening curve. And B, the fact that we are beginning to get worries of a bit of a risk off move in assets, simply because we realize that we are going to be in a period where duration issuance from, let's say, immediately, but especially in a couple of months' time, is going to be so much greater than we've been digesting up to now, and therefore QT is going to be so much more effective than it has been in the past 6 months when we've been starved of this duration, that people are beginning to switch out of equities into the short end of bonds where they feel a lot safer than they've been. We've been in risk on for something like 6 months now, and we're beginning slowly to shift into risk off. I think equities are not going to perform well over the course of the next 2 or 3 months. And certainly the longer end of the bond curve is going to have trouble too.
Yeah, so I agree, Nick. Risk off in equities, weakness on long term bonds, strength on very short term bonds is the risk off nature and probably what we're going to be in the near term. Last week, we also saw payrolls and the last two big earnings announcements from Apple and Amazon. What'd you take away from those things?
Well, the payrolls were weaker. The wages component, though, was stronger. And I don't think the Fed's going to like that. Although the market took the opportunity to take profits on their bond shorts and really square up for the week, I think the long term direction in bonds is now set towards higher yields as the auctions hit, as the duration selling continues, not probably in the very short term, but in the longer term. And I really see no reason that the Fed should be happy with what is going on. The pricing in the bond curve basically now suggests again that we're starting to price in some cuts for December of 2023 and quite rapid cuts throughout 2024. I think the Fed is not going to like that, but that really depends on what happens with CPI. But yes, Apple and Amazon really counterweight Apple throughout the day on Friday, but at the end of the day, we got some really violent liquidation selling in equities, and everything tumbled over a percentage. I mean, SPY tumbled over a percent in 2 hours. That to me is a sign of weakness. Now that the earnings are out of the way, I think we're going to concentrate much more on multiples rather than earnings. We've had 80 odd percent of the earnings that we're going to get by weight in the S&P. So earnings is more or less over. Now it's a question of determining what the right multiple is for the index. And with yields, going up towards the 4.25, 4.5 level in the very long end of the curve, I think that we are still too rich in multiples, and we could easily tumble another 3, 4, 5% over the course of the summer.
Yeah. So I agree with that by and large. I would say that one takeaway from me for the NFP, well, really the Fed reaction function, what we talked about in last episodes was that we're in a period of time where for 2023, we're going to shift from no hikes to one hike and back and forth on data. And we're now priced for no hike in September and cuts in December. And those probably come out on the next warm number. Maybe they're enhanced a little bit on the next, but I don't think we're going to have cuts in September or November priced in under any circumstance. So, that's what's back and forth. So, what is next week, Nick? What do we have?
Well, we've got a lot of issues. We have threes, tens, and 30s. And funnily enough, the 30s come on the same day as the only really important piece of data, which is the CPI on Thursday. We do have the PPI on Friday, but that's really less important than the CPI on Thursday. CPI has been a slight cold number for the past three outcomes, 3 months. Really, the question becomes, are we seeing the last of the base effects that have been bringing down CPI, in which case the bond market higher trajectory in yields reaccelerates? And do we get some substantial higher inputs from the oil prices, which have really risen by, well, 15% in the past month? When does that come into the figures? Does it come into the figures now, or does it come into the figures mostly next month? And I would have thought it mostly next month, but you could see a little bit starting to come in now. So really, we are at the end of the good news from CPI. And that's why I think the Fed is not happy at the moment.
Yeah, that makes sense to me. The issuance, just on the issuance, because of the quarterly refunding and the larger deficit, the issuance of threes, tens, and 30s was supposed to be 96 billion and it's now 102 billion. So, issuance is up 6% this week. But again, I think the important thing on the quarterly refunding and this large issuance is that it's steady and growing and will no longer mute quantitative tightening. Yeah, so on the
I,
back of that, Nick, what do you think about our macro outlook?
I think we have it about right. I think, the duration issuance is not going away. It's only going to get worse and worse. So I think that We don't want to be buyers of the longer end of bonds. We might be tactical buyers of the short end in case of some risk off, with as defensive as we possibly can be in equities. And I think that is the right position to have for the foreseeable future. Well, how do you see it, Andy?
Yeah, I agree. I think our portfolio is defensive and should be. And the only thing we can use is some of our ammunition, our defensive ammunition, to, to me, take advantage of a sell off. And I think the best way to do that at this stage is looking at out of the money puts on equities at levels that we care about selling to buy equities.
Absolutely. And I think, as I said earlier, we could easily get a move of another, say, one multiple, which is around 200 points. Because if the expected earnings are around 220, each time we take one multiple out, that's a move of about 200 points. So I'm not a buyer here. I might be a buyer at 200 points lower. So that is more or less what I'll be doing in my segment, and looking at levels that make sense to sell puts at for the next 2 or 3 weeks.
Sounds great. Talk to you next week.
Excellent. Have a wonderful weekend. Let's have a look at our portfolio. As we emailed you on Wednesday, we reduced the equity allocation to the minimum of 20%. We are slightly below. That's because the value has gone down. So what did we do? We sold the call that we had, the 440 call, which was deeply in the money, and we bought 30 shares of SPY instead to basically get to an allocation close to 20%. Everything else is unchanged. The chart pack has been updated. The broker statements are downloaded for the weekly and for the monthly, so you can see it. The performance also is updated. And let's have a look at the order entry. What are we doing? We are selling 4 IEF 93 puts and selling 1 SPY 435 put, both to August the 18th. Why August 18th? Because we feel that is safe enough, and also it's before the Jackson Hole Fed symposium, retreat, whatever you like to call it. And I'm really not very happy about being short options over that. So expiry August the 18th makes sense to me. And it makes, these are limit orders. So if we don't get them, we don't get them. We are looking to take advantage of a risk off move in both IEF and SPY. So let's have a look on the charts, how that looks and why those levels, why 435 and 93. If we have a look at SPY, 435 is roughly here, which is 0.5 retracement of this whole move up. And on a weekly chart, you can see that whenever we've basically broken the these are levels which tend to hold around the 430, but I reckon 435 is safe enough, and it's only for a one, so that would increase our allocation by about 15%. So we would go from 18 to the low 30s. And if we have a look at IEF, I feel that over the course of the next 2 weeks, very unlikely to go below 93. And if it does, we want them. So those are the rationales that we have. I know exactly what yield level that is, and that's an attractive yield level because I think the yield curve is going to pivot. So I am comfortable with both those orders. Once again, here you have them selling for IEF, and that also would increase our bond allocation by about 12-14%. So very happy with both of these orders. Have a wonderful weekend.